Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's a fascinating time to be managing a super fund in Australia. They've benefited from the economic and share market recovery to deliver some of the best returns to members in years. Increasingly, we're seeing more funds as major players in the purchase of large assets, particularly in infrastructure. And with the superannuation guarantee now at 10%, the super funds have more money to invest. But at a very personal level, superannuation has played a key role in helping people get through the pandemic, with around 3 million Australians accessing their super early. At the same time, the Your Future, Your Super reforms introduced this year have made some significant changes to the industry, not all of them welcomed by the funds. Over the last 20 years, CareSuper has been one of Australia's top-performing super funds. It was founded in 1986 to manage the super of office-based employees and is now the largest fund for professionals. It's also a great supporter of Fear and Greed. Julie Lander is the CEO of CareSuper. Julie, welcome to Fear and Greed.
Good morning.
The super landscape is a tricky one to get your head around when you're not in it day to day. Where does CareSuper fit into that landscape?
Well, you've introduced us very well. We've been around for about 35 years and we do focus on the super needs of professionals and office-based people, although right now we know that many of our members could be working from the kitchen table.
Indeed.
Our focus has remained unchanged over the last 35 years. It has and always will be to support our members to achieve their best possible futures and really to make a difference to their lives. We hopefully spend quite a lot of time in retirement and people need an income. So That's what super's all about. And of course at CareSuper we want to maximise that income and make sure that people have choices in retirement and can enjoy the lifestyle they've dreamt about.
So how many members have you got and how much funds under management?
Well, at this point, we've got almost $20 billion in funds under management and about 220,000 members. So Sort of a medium-sized fund. It sounds large, but, we're medium-sized and that means we're really able to be agile in the market, execute an active investment strategy, but we're big enough to make a difference and really to deliver for our members, but we're small enough to care about them too and understand them and how they think and how we can make their lives better.
Okay, so you're talking about the market. There's been lots of mergers in recent years and certainly regulators are pushing down that path. Does being a medium-sized fund protect you from that? Do you think there will be more mergers in the industry going forward? How do you see that landscape playing out?
Yes, there certainly has been a lot of merger activity over the last couple of years, actually, and we've seen the emergence of what we might call mega funds. With the introduction of so much government regulation and different changes and things like that, we're probably going to see more mergers over time. But I really believe that there's a place for boutique industry super funds like CareSuper that have a different value proposition to some of those mega funds. We don't want every fund looking the same and being homogeneous. So we really believe that a fund of sort of CareSuper size, although we've certainly got a bit more capacity to grow, has a different value proposition in the way it can invest, the way it can service its members, understand its members, build affinity with them, and offer a more personalised service.
Yeah, I often wonder that. So compared to AusSuper, which is the biggest industry fund and is probably 10 times your size in funds under management or thereabouts, right?
Yeah.
The thing I think about those really big ones is that I'm not sure how they make themselves different. I mean, the comparative advantage is their size, I suppose. The thing about medium-sized funds, which I wonder, is it more on the investment side where you can make a real difference, or do you think it's more on the service of members side that you can make a real difference?
I think it's both. And funds of all sizes are going to exist. And I think really each fund has to make the most of its size. But a fund the size of CareSuper's can effectively implement an active investment strategy, be nimble, take advantage of capacity-constrained opportunities. And by having that model, we've really been able to demonstrate over the long term really strong risk-adjusted returns and provide a smoother ride for members. Those larger funds will do things differently and members should be aware of the differences. They'll invest differently and they'll probably expect members to deal with them electronically more.
Yep, yep.
We have to have a strong electronic platform as well, but we're very happy to deal with people on a one-to-one basis personally over the phone, and we visit workplaces and encourage people to meet with us, ideally in a normal world, face
Yep.
to face, but otherwise virtually as well.
Stay with me, Julie. We'll be back in a minute. My guest this morning is Julie Lander, CEO of CareSuper. Okay, now the market at the moment, there is so much M&A activity going on away from the super funds, but certainly the super funds are part of that. Why do you think super funds are becoming more active in buying some of these assets? And even in terms of investing in infrastructure particularly, it seems that all the infrastructure assets that are up for sale seem to have a super fund attached to them somewhere along the line. Why is it that infrastructure is such a good investment for super funds, be it direct or via, buying on the market?
Infrastructure has become a really important part of our investment program. Of course, we invest in listed assets as well, stock market, for instance. But the beauty about infrastructure assets is that they play the role of being a really good diversifier to those listed market assets. They're sort of usually less volatile than shares. They also have the possibility of achieving better risk adjusted returns than other asset types. And there's a view that the trend towards long term ownership of these assets ties in with the long term goals of superannuation. We are investing really for the long term. Most people are going to be in super for 50, 60, 70 years. And we've got to look at that long term goal. So these sorts of assets provide good, stable returns over the long term and are a good diversifier for listed assets that can show a lot more volatility given that they're subject to the vagaries of investor sentiment. So the bottom line is that there are lots of merits to that asset class because of the high cash flow and more stable returns and good long-term growth prospects.
Another thing that super funds do for members, which is more difficult, I think, on an individual basis, is invest in overseas assets. Do you think that super funds, just because of the weight of money coming into the local market, they've got to invest it somewhere, will increasingly put money into overseas assets?
Australian super funds already invest overseas, and overseas funds invest in Australia too,
Yeah,
you might
yeah.
be interested to know.
The
So,
Ontario Teachers Fund, we're always hearing about that one.
yes, and they're very interested in infrastructure assets too.
Yeah, yeah.
And, the interest in infrastructure assets started a few years ago when we saw the privatisation of assets that were previously owned by governments. The beauty about this too, I think, about Australian funds owning these assets is that they stay in Australian hands, and that's the role that we can play in nation building. So that's really another, I think, strong side aspect to investing in infrastructure. But of course, our sole purpose is to provide strong risk adjusted returns for members, but there is that added benefit of doing it.
Investing overseas is one thing. You're going to invest in Australia. Is there a risk with so much money flowing around Australia that the fundamental prices of assets will rise too high when not just super funds, obviously all investors are trying to get their hands on those assets?
Look, investing is a global business, but in terms of whether funds could end up paying too much for assets, which I think is where you're going,
Yeah. That's exactly it.
I don't think so. I mean, as professional investors, we need to know what is the appropriate price to pay for something. And, we have to be disciplined about buying things at the right price. But there's a strong deal flow. So there are lots of assets going to come onto the market. There are a lot of drivers for that because we need to see sort of infrastructure modernisation.
Yeah.
There's always the scope for infrastructure to be modernised and upgraded. Even in first world countries, there's a lot of ageing of assets and there's always investment needed. With the shift to decarbonisation of electricity, there's a lot of room for investment in the electricity sector to decarbonise it.
Yeah.
There's use for data and cell towers and things like that. And because we're seeing population growth, there's always going to be the need for more assets. So In terms of whether there's a frenzy or people are going to pay too much for assets, I don't think disciplined investors do that. On the other hand, there are potentially some sovereign funds that may have lower return hurdles and they might have different objectives. They might pay more for an asset than a super fund might. But, I think this is also another really strong aspect of funds like CareSuper, where people can access the benefits of infrastructure, which is really very difficult to do as an individual investor.
Yeah. Just quickly, your super reforms were introduced into Parliament earlier this year. Things like stapling, so you basically have one fund that follows you around from job to job, the online comparison tool, your super, annual performance testing, duties to ensure super trustees act in the best interests of members. Were they reforms that were needed? Do you welcome the reforms?
We certainly welcome the intent of the legislation. Super funds should always be doing the right thing by their members, and we would say that we've always had that fiduciary duty to act in the best interests of our members.
Yep.
But this legislation, I guess, strengthens that. In terms of stapling, yes, what we've seen over the last 20 or 30 years since the advent of, let's say, compulsory super, is that people have acquired multiple super accounts just because of the way the system's worked. And that hasn't necessarily been in the best interest of people. They've been paying multiple fees and insurance premiums potentially as well. So the intent of the legislation to stop this proliferation of accounts is good.
Yep.
So we're supportive of that. It is a change for super funds, and it's certainly going to be a change for employers once the 1st of November comes around, because they will have to onboard new employees a bit differently and realise that they can't just sign up all new employees to their default fund. They will need to offer people a choice form, and if that form isn't returned, then they'll need to go to the ATO to find out what the person's stapled fund is, i.e. a fund that they've already got in the system. And only in the absence of one of those would they then put somebody into their default fund. And, of course, there are people, working their first job, so there is always the need for a default fund.
Yeah.
But it's very hard to get legislation perfect. One of the things that we would say about the way that this is going to work is that people could still be stapled to their existing fund, which is an underperforming fund, if that's the case. Having said that, there are very drastic measures for funds if they do underperform, and they will have to write to their members to advise them that it's been determined that they've underperformed. And when we say underperformed, it's underperforming a benchmark that is unique to that fund based on its own strategic asset allocation. It's different to underperforming the median or the market or comparable funds. So members will need to be aware of that and what underperformance actually means. The underperformance test is really about underperforming what you say you're going to
Yourself.
do. Yeah, underperforming your own objectives.
Yeah.
But what we've seen is that is possible, and we're talking about a measure that says if you underperform your own objectives by only 0.5% over a 7-year period, or 8-year period it'll ultimately be, but 7 years this year, that's actually not much leeway.
No, not at all.
Yeah. But CareSuper, I'm pleased to say, will not be an underperforming fund.
Fantastic.
Yeah, which is great news for our members. But not only is it not underperforming its own benchmark, it's been a very competitive and high-performing fund over many years.
That's a great place to leave it, Julie. Thank you for talking to Fear and Greed.
Okay, thank you.
That was Julie Lander, CEO of CareSuper. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.